On the Tape is presented by CME Group, where risk meets opportunity, and iConnections, reimagining how the investment industry connects.
Welcome to the On the Tape podcast. I'm Danny Moses, along with Vincent Daniel Porter Collins for a special What Are We Doing this week? Dan and Guy are basically Tubbs and Crockett this week. They've been down in Miami at the FactSet Focus User Conference this week, and I've been busy. I've been doing a lot of shows, a lot of different things. And they sat down with the CEO of FactSet, Phil Snow, which will be on the backside of this podcast. So definitely take a listen to that. And then also, they're hard workers. They're getting back tomorrow, and they're going to do a live market call at 1 o'clock and talk about the jobs report, right, which would be important, and Apple's earnings. Two of the things they're going to talk about tomorrow. So they'll be back. But I got my own Tubbs and Crockett with me here, who are also private detectives in the market. So welcome, boys, to On the Tape.
Thank you. And at one point, Guy rocked the Miami Vice.
100%.
He probably still does at this point in time somewhere.
I bet
in
Halloween,
Jersey.
at one point, Halloween, he dressed up. That's my call. You want to take even money on it? I have no knowledge of that, but there's a chance that he dressed up.
So I have to take the under on that?
Yeah, you could say no.
I'll say no, but I believe that
we'll
you're
go
right.
for
You
a
probably
beer
give
on
me odds on that.
I don't think Porter could have pulled that off, Tubbs or Crockett. Do you think so?
Really not.
Okay. Anyway. All right, boys, lots to talk about here. We're going to get through it. Obviously, top of mind was the Fed meeting yesterday, preceded by Yellen's Treasury thing that they did with the QRA going on and, talking to the market. We got Bank of Japan intervening nonstop, it appears. So let's kick it off with kind of how you guys were set up, and did you do anything differently post-Fed Powell news and his conference and so forth. So let's start there, boys.
And there was obviously a lot of anticipation up until the QRA, which is the quarterly refunding amounts, the
announcement,
Fed,
the
announcement, the Fed numbers, there's a lot of PMIs came out, and so we were so confused we didn't do anything. And one thing we in our old age we've done some things smarter, and one of them is always bet that Powell will be dovish. And so on that, we actually won. So we're feeling good here that, the market's sort of taken this as a sign of relief. The bond market's taken as a sign of relief. I don't really think they said much. I mean, they did. They punted. They kicked the can.
Well, they did do something with QT as expected, but I know we're going to talk about that too. But for him to
that's kick the can. That's a Michael Cohen kick the can.
Calling him dovish by saying that he's not going to be raising rates as his next move, more than likely. That's what people took away as dovish. I don't think there was a lot of expectations that the Fed would be raising rates. I think it's just higher for longer, Vin.
I tend to agree. See, we came about it, and we've been coming about this, I would say, for the past few years, and it's become more and more solidified with us, is that in an era they call it financial dominance, which is a very fancy way of saying we spend a lot more money than we
fiscal dominance, financial dominance,
same shit.
Okay.
We spend a lot more money than we're bringing in, and we have too much debt. So they called it fiscal dominance. That he has to say things to keep the market elevated. So when you start with that premise, you say to yourself, okay, what is he going to do? And you don't really know. We're not that creative. What is he going to do to keep the markets up? What I think he did was he striped 325 yards down the fairway of making sure volatility stayed low. I think the big thing for me, and everyone has their own opinions, for me was QT, the reduction in QT was a little bit greater than expectations. So as a result of it, people viewed it as dovish. That also, as Porter said, the one thing he was very definitive on, or more definitive than most, was I'm not going to be raising rates. So the combination of the two, I think, created a dovish tilt.
So I think when you say he needed to please the markets, I think he needed to please the bond market, because he knows that that's the tail, and that's the dog that wags the tail.
More so than the equity market.
Right. So just to be clear, what he did, to everyone out there in the quantitative tightening, what he had been doing was basically letting $60 billion a month of treasuries run off without reinvesting, and $35 billion of mortgage-backed securities. He maintained the $35 billion because he actually made a comment that only $15 billion have been maturing because rates have been so high and prepays on mortgages are low. And then he's going to lower by $35 billion the amount that he's going to let basically run. So he's going to basically let $25 billion run off instead of 60 on treasuries. Obviously, he coordinates that with Yellen and everything like that. And I want to bring this to kind of back to the global central bank here. And I agree with you. He said what he had to do and he held the markets fine. I think that Japan has been the center of a lot of this. I go back to 2 weeks ago where South Korea, Japan, and the U.S. basically had a, tri-party call about currency interventions. It appears, according to Peter Bookvar's, science, and he's pretty good at this, that as of even, it's probably more than that now, at least $60 billion Bank of Japan has intervened to support the yen. The yen got near 160. We're hitting a 153, 154. And we've been talking about it on this podcast for a long time. You don't have to care about it, but you better watch it. And so, Porter, what is your take on that? Because at some point, if that stops working, these interventions, and by the way, Bank of Japan said that they won't disclose the intervention total until the end of May. So anyway, Porter, run with that and just give me a little if I'm looking at this thing correctly.
Well, I'm going to keep it simple and bring it back to something I said at the end of last podcast, where the 10-year was sitting at 430. And I said, listen, if rates go a lot higher, I'm going to get nervous. And sure enough, in the past month, rates went from 430 to almost 475. And I think it's all along the same theme. And what Vinny touched on earlier is that Japan's got too much debt. The U.S. has too much debt. We're not slowing down this trend, and it's going to keep going. And so the longer this goes on, the more and more nervous I get. And
nervous for people that are long the market, or nervous for you being short the market, or not that you are short the market, but when nervous meaning what? That you won't be able to make investment decisions because of all these unknown factors, or what makes you nervous?
Honestly, it's more. It's nervous about the system, honestly, and because we need to keep rates low to service all this debt, and talked about the CRE problems, all the debt out there, all the sovereign debt. I just don't think the world really works with 10-year rates at 5, 6, 7. Like it's not going to work. And that's the reason the market's begging for lower rates, right? And you've had over the past month, 2 months, we've had a ton of inflationary news, right? Worse than expected inflationary news. But the equity markets and even the bond markets are begging and want rates lower. So anytime you get a relief, hey, it wasn't that inflationary, or bad economic news, the market goes up, right? And so we know the problem. Everyone knows the problem, but everyone's not worried about it. I'm worried about it. So and that's the reason that we've positioned our portfolio to potentially take advantage of that. It's not an easy thing to do, but that's how we think about it.
No, for sure. And Vinny, before I turn it back over to you, I think, the one thing that Porter's kind of talking about, or the biggest fear, is stagflation. We've started to see pieces of that for sure. And as Peter Bookvar notes, and he does a great job, again, to give him another shout out on all these conference calls and transcripts, eBay had the best comment, I thought, of all the things that he listed. And that was the way that they described their business and their consumer, which was challenging and dynamic. And I think it's the haves and the have-nots here, what we're seeing. So in this type of environment, which is beginning to look like a little stagflation here, we're going to get into some single stocks here, obviously. But talk about that aspect, and then let's run through some names, some of the greatest hits of Seawolf greatest hits at the moment.
Well, it's funny. I'm going to give a shout out to Peter. This is going to be the Peter for our
Love
podcast,
Fest,
right? Yeah, Love Fest right now. By the way, big Jet fan. He had a really decent draft. And in one of his recent notes.
Now I know why he's bearish all the time.
Exactly. And one of his, it's so true. When you think about it, really, I mean, he hasn't seen any light of day for the past 30 years. But he described the economy. It was probably the best word to use, is uneven, and that's the way I feel about it, is uneven. If you are someone who owns assets or has wealth and has a 30-year mortgage, life's pretty good. Or if you
locked it in before 2 years ago.
Correct. Yes. Life's pretty good. Or if you're on the right side of fiscal largesse, let's take the Inflation Reduction Act, the CHIPS Act, life's really good. So you take a look at earnings like GE, or if you're the semiconductors who are making chips for AI, life's great. If you do not own assets, if you're on the wrong side of the cost of living, inflation, whatever you want to call it, life really sucks. And so I think you're seeing names, and now we'll get into individual names. We're not involved, but names like Starbucks and McDonald's. McDonald's, which is supposed to be a defensive name, had very poor earnings. Starbucks, everyone uses a different price for the latte. If I'll say $12 lattes, are not selling all that well. Now, part of it, and I saw a bit of Kramer's rant on management, part of it is a management thing, but part of it is the fact that when you're strapped, the last thing you're thinking about is going to Starbucks to buy a $6 Frappuccino. You're just not doing it. And I think we're starting to see that. And so therefore, it makes very interesting for people like us to invest in things that are working versus avoiding or even shorting things that are not working. But as an American, it's not healthy. I don't think anything we're seeing is healthy. It might be good for a market participant, but it's not really good as an American.
Yeah, when you have higher labor costs like they're experiencing, I go back to the Red Cup day last year, they only can raise the price of a tall latte so much, right? And I think that they're getting squeezed on both ends, the inability to raise prices, but they're being forced, obviously, to raise their costs at the same time. So I don't think you're involved in Starbucks at the moment. You might have been, but let's talk about some of the names you guys are most hyped up on. Let's start on the long side of things because, we're noted.
We're the three bears.
We're the three bears. So let's start on the long side of things. And I know you have some always eclectic, always fun. So I don't know who wants to kick this off, but maybe Porter, maybe give us a 2 or 3 of your top picks here, and then could have been.
Well, when I look at the overall market, I'm sort of confused, by the daily whipsaw of stuff, and not exactly sure which way to go on things. And obviously there's some good earnings in terms of Amazon and Google, but bad earnings, and we just talked about. But one thing we've been focused on for I think almost 4 years now, we've been long uranium, and there've been fits and starts of this move. And I think last time I pitched it, we were down in Miami, and that was the exact 52-week high when 106 down to 84.
Top tick McGillicuddy. All roads lead to Miami, by the way. All roads lead to Miami. All right, yes. Keep going, Porter. Sorry. Yeah.
But, I think that the simple story here is that, demand is outstripping supply. And supply is coming from weird places like, Kazakhstan and Niger. And they're just not good jurisdictions to mine. And, you've seen like with this latest deal with Amazon, they contracted with Talon Energy to get a data center hooked up right next to a nuclear power plant. And so I think this trend is real. And finally, you've starting to see, restarts, the first ever restart of a nuclear facility in the United States. And you've seen extensions, I think 10 or so extensions of nuclear facilities here in the United States. And obviously you have, I think 60 reactors around the world being built right now, mostly in China and India. And so this is just a slow and steady, supply demand story. And I think, if you think about the spot uranium, which is what we own the Sprott Uranium Fiscal Trust.
So it's U.U?
Yep.
The letter U. Letter U. And remember, for those people out there on the Gold Trust, PHYS, under the same Sprott umbrella, which, by the way, a shout out to Cy Jacobs, who has been a noted Sprott investor, SII, which has been a monster.
Which we also own. We own SII.
So you can be the benefit of
thanks to Cy getting us over leg, spoke to management. And if you really want to own a proxy for all things precious metals, you can own Sprott, the asset manager. SII is the ticker.
And it's got a nice dividend. They've had a nice quarter. So, Porter, we got the uranium play.
But I think uranium can double over the next couple of years.
Got it. And Russia also, right? They had they're off the market. They had a lot of supply too that's been basically taken off the market, or is that not correct?
Yep. Okay. They're basically buying up supply and never putting it back on the market again.
So, Vin, you're up with a long here.
Well, the other name that we've been buying, it's a bit small. It's about a $500-600 million market cap, and people, please do their work. Is this company called Coastal Financial Corp. It's a bank, believe it or not.
Oh,
right.
What's the symbol?
CCB is the ticker. They're out slightly north of Seattle. And if anyone knows me, knows I love the city of Seattle. I have very good friends there. They are what is called a rent-a-bank, although in modern times you would use something called banks as a service, or BAS. You get a higher multiple if you say that than the old school way. And over the last, say, month and a half or 2 months, we caught wind of the fact that they announced 2 major relationships in their rent-a-bank business model. One is they are the underlying bank for Robinhood's credit card, their gold card. In addition to that,
It's not an oxymoron, Robinhood Gold Card, but please continue. Yeah.
Well, the hysterical thing, and this is an issue for Amex, is that Amex, the platinum card, costs more than the gold card, but the price of gold is actually higher than platinum right now. And the other relationship that they have is the deposit relationships powered by Walmart. So think about two, and they also got others such as Progressive and the like. So for this little $500 million market cap bank, they've developed some pretty deep relationships with some very large brand name institutions to be the underlying, call it white label bank sponsor. I think the reason why they've gotten it is because they lead with compliance. In addition, from what we have understood, speaking to management, they have a great relationship with Walmart's venture capital fund. So all the things they've invested in, they're pretty much the underlying bank sponsor. We had a feeling 1Q was not going to be pretty because of a little bit of commercial real estate. They also needed to unwind some of their risk associated with the prior bank thing. But
the maturity stuff. Yeah.
But in addition for that, I think you got a 3 to 5 year runway that this could be one of the preferred ways for all these big brands who want to be in banking, but don't want to use some of the other banks. So that's what we've been buying as well.
Interesting. So and we are going to get into some vice stocks later, some gambling stocks, obviously, we're going to talk about. I will have my Derby picks for you guys, obviously, towards the end here. But Porter, one sector before we go back into companies' specific stuff is obviously energy. We've seen the price of oil here come in, kind of breached West Texas, kind of 85, 86, 87. We kind of hovered here on oversupply concerns here, kind of below 80, and kind of things being okay in the Middle East for the moment in terms of further escalation, certainly in Iran. So what are your thoughts here, and how are you guys navigating that kind of with oil where it is?
We haven't really changed course at all in terms of oil. Our biggest position continues to be Petrobras, which got a bit of a relief recently as they had reserved for a dividend, but there was some political noise around that, and they finally released that dividend. So
Pabst Blue Ribbon,
we're getting
PBR, right? It's okay.
Pabst Blue Ribbon,
yeah,
got it. All right.
We're getting a mid to high teens dividend yield at more than half the valuation of all the big oil producers around the world, and we continue to think that that's one of the best assets in the world, and grossly undervalued. So that's our sort of easiest runway idea in oil.
Vinny, I assume if there's not an additional oil, I'm done talking about longs at this moment. I'd like to.
You've had enough?
Well,
Tesla.
I'd like to talk about Tesla and Carvana.
Yes, I'd rather talk about those two.
Right.
Well.
So I know you guys have a lot to say on it. A lot has happened actually since the earnings report has gone on with Tesla. Obviously, Carvana just reported yesterday. We can talk about the low quality quarter that's still getting shorts to cover. I'm not involved at the moment. I don't believe you guys. You may have traded it well in the overnights. That's fine. But let's start with Tesla and everything that's gone on here in the last kind of week post-quarter, because we talked about it last week and what you guys are thinking from here. So I don't know who wants to kick it off, but go ahead, Vin.
Well, I'll start with a not so funny thing. I mean, I assume it's true. Sometimes you see news items coming out of Tesla and you're like, that can't be true, right? So last night there was one. I wouldn't say it was a big one, but it was.
Doesn't he always say, Musk, believe what you see, not what you hear? So we'll talk about things that you're actually seeing.
Another brick in the wall for this name is they, I think, notified the potential interns that were coming into.
Oh, I didn't see this one.
Tesla this summer that they no longer have an internship there. Now, for a person who's worth $1 billion, you don't think it's wise to, now assuming it's true, and again, I don't know if it is or it isn't, assuming it's true, you don't think it's wise to have interns working there? I mean, if you're all about narrative, you can't afford to pay money out of your pocket, the interns.
We know he doesn't.
So, but it gets back to, let's assume it is true. This company seems to be having cash flow issues, and I don't want to like conjure up some crazy bear case.
What do you mean they just burnt $2.2 billion in cash last quarter? You're not making it out.
As you know, I listen to the cult as sort of to say, where the hell am I, right? And they say people like us make up a lot of crap, right? But their actions speak louder than words. And aside from 1Q earnings, where you're right, they had a $2.6 billion cash outlay. They don't really have a product refresh. He complained 2 quarters ago about higher for longer and what rates were doing to the movement of metal. That has not changed. All the numbers that are coming out seem to be, again, it's early, but seem to be the 2Q volumes are going to suck. I just don't see, other than what the machines are doing and the ODTEs and the options players and all that, I don't see any reason to own this thing now, particularly after this horrific short squeeze.
And so, Porter, I'll turn it to you. And I was talking to you the other day about this, and three of us were talking in a therapy session about it. But in the way of, we've talked about this ad nauseum with other names, that the long-only community was underweight Tesla. Okay. And it's a very large market cap. I mean, it's $500 billion, and it got up, I don't know, it's run towards the 600 and come back here a little bit in terms of market cap size, but their hands got forced. And we got confirmation of that in general, where long-only tech flows reported by one of the big houses in the last couple of days were massive last week. And I believe it was them. I believe it was that stock was kind of the pro. So those are technical factors that people get to go. But you just made a point about all the things that have happened since the quarter. Flies over to China, gets some deal done, at least that he can talk about. The Baidu thing was old news about this mapping software. It was all bullshit. And then Supercharger Network and people leaving the company, the head of human resources, nothing really lines up right. So we know from a fundamental basis the story is not trading on fundamental. It's just not. It's trading on a 2030 dream here that he's yet to really follow through with any. So Porter, give me your quick thoughts on Tesla.
I think it's going to get cut in half, like at a minimum.
All right. So we're sitting here around...
Porter, I love the confidence that you just threw
that's
out.
the most confidence
That was so Danny right there. It was incredible.
That's the most confidence you've been in the last 25 minutes.
I'm usually very nervous about my shorts, and this is one of the easier ones I've seen in a long time. Honestly, from a fundamental perspective, the company this is the worst situation I've seen this company in 5-6 years. I mean, at the time when he thought they were going to go bankrupt, they're about that bad right now. And I really think that this quarter is going to be absolutely terrible again. And, he's running out of things to say, right? He did the whole, Model 2 to robotaxi pivot. I mean, and they reversed course from the unboxed strategy. It's a complete, I'm not going to use those words, but it's in a really bad place. I think the stock's going to get cut in half fairly quickly.
Porter, were you about to say it's like taking candy away from a baby?
No,
he was going to do Ponzi fraud. He was going to do a lot of stuff.
Do you remember, by the way, a little Front Point history? We were short, I think it was State Street, right? If it was Bank of New York or State Street. And Steve, God bless him, he still does have some of the best lines, as we know, when he was on CNBC. He said, this is like taking candy away from a baby. And I think the next day the stock was up 15%.
Right.
It's never in our face.
This is the easiest trade I've ever seen.
Yeah.
Right. It's never. All right. So let's go to Carvana. Porter, you start with the Carvana. I want to go to Vinny because the stock obviously is up massive today. It's had a squeeze here for a while and a big squeeze today. It feels like that's could be one of the last squeezes. I don't know. I am not involved in the story. I'm not as up to speed as I should be on it, but I know you guys are up to speed on it. So I don't know, Porter, kick it off and then go to Vinny here.
Well, I just want to say one thing in terms of, getting smarter as we get older. The short interest was just too high, right? And it was a 30% short interest. Same thing with we were looking at some of these other shorts. B. Riley, the short interest was 80%. It's impossible to short stocks with that high short interest. It's just impossible to win. So thankfully, we were not short Carvana in front of the earnings print, but.
Doesn't look like a high quality quarter. Just talk to me about this non-GAAP bullshit cash flow. So,
well, I got a few things to say on it. Just to give you a backdrop. A week ago, my alma mater has an annual stock pick competition.
Binghamton
University, and a bunch of us were there. I'm one of the many judges that are there all the time. Our protege Ronnie Sannon was there. My buddy Mario Sabelli was there, and these three young kids pitched Carvana as a short, right? And so it's judged based upon not just whether you like the short or based upon presentation or not. These kids were freshmen, and they did such an amazing job waxing poetic about the debt cap structure. They were talking fixed income as if they were working.
They're this bearish at 18, 19 years old. I feel for them,
and I felt for them.
Yeah.
But the one place where they made a mistake. And they won, by the way. But the one place they made a mistake is they said their upside or their risk target was $85 to $87. And both myself and others jumped on him and said, dude, when you have a stock, or dudes, because there's three dudes, when you have a stock that is this heavily shorted with this much ample liquidity, you can't say that your upside's only 10, 15%. And Ronnie was the one that said, this stock can double to $160 right in your face because They have a horrific capital structure. So to get back to the fundamentals, they have a horrific capital structure. If the management can somehow get this stock up, they could raise capital and collapse their cap structure so they could be a normal company. And right now, if I was Ernie Garcia, who is the CEO of Carvana, if they're not out and raising equity capital tomorrow, they're morons. And they're not morons, these guys. They're extremely smart. Little crooked, but they're really smart. So
the market cap is right now twice of CarMax.
Yeah, which is
moronic. You know that.
It's ludicrous. But it gets back to what Porter's saying and where I'm driving is that we're in an era where liquidity is rampant. You have quantitative algos targeting fundamental shorts, people like us. You have to be extremely careful when you see a short interest that is north of, say, 10, 15, 25, 30, 40%. You just have to be. And it's better off for your own sanity, for your own health, to stay on the sidelines and wait for the massive blow off top in the name before you can short it again. Maybe we got it this time. We'll see.
Okay. Well, let's get into this. When our time is precious here, let's get into some Vice stock. Let's start with Flutter, which is FanDuel, for those people who don't know, who decided to dual list a few months ago at the end of January on the New York Stock Exchange. So their main listing was still London. Just came out and said they're actually going to move their main listing over to the New York Stock Exchange. A real blow to the LSE, in my opinion. But Porter, I know you've been on the story. Obviously, you have been on this story for a while, just on these stocks in general. They're going to be reporting next week. But tell us how you guys are positioned. I think you are long Flutter, F-L-U-T, correct?
We've been a long Flutter for a couple of years now, and you know, I think, you know, we've obviously seen the wave towards gambling in the United States, and we obviously, shocker, chose the conservative route with Flutter, and they owned all these overseas assets, which were the crown jewel of the company, and they also have FanDuel in the U.S., which so they were producing a ton of cash at the same time, which they can reinvest in the U.S. And so now it's come to a time where they felt like that. I don't exactly know why, but they're going to get a list in the U.S. and probably get a higher valuation, join the S&P, and so I really think that this is sort of a good time to get in, as you know, the fundamentals are definitely inflecting. Stock is not an expensive stock at all, and prospects are pretty good at this point.
Right. I mean, we talk about technicals versus fundamentals all the time. It's fun to be on the right side of passive investing because once they do list, they are not in any. Yes, they're going to come out of the London passive funds, but they're going in, to Porter's point, to the large ETFs that are going to be here.
And the selling has already started to occur in the
UK
on the FTSE. So,
yeah. So DraftKings reports tonight. I don't know. I think the quarter is going to be good. I think it'll be fine. Genius Sports is another one, Vinny. I know that we're all involved in. Stock has been hit on the kind of a large shareholder have been selling. I think it's a huge opportunity to buy it here. GENI, they report next week. But give me your thoughts on the sector, because you guys know we've been together a long time. This was always a sector.
Well, I almost refer to you because you are the resident vice analyst, particularly when it comes to gaming and cannabis as well. My question for you is a risk factor, because I always like playing the risk guy. Do you worry about the competitive landscape of all the players involved, whether it's FanDuel, DraftKings, MGM Grand?
No, not at all. Because I think that the product offerings, the economies of scale that they have, it's very hard for smaller companies to come into this point and acquire any of those clients. And I think in the case of someone like a FanDuel, who offers, I'm going to talk horses again in a second here, but they're huge in horse racing. TVG, I mean, that's Betfair. That was them, right? They kind of saw DraftKings is actually still growing in the horse business, for instance, trying to get the wallet to combine. So there was so much, how do I put it, licensing issues, red tape to go through. Yes, these companies have paved the way for everybody else, but I think it's the Visa and MasterCard, those two of the group. Yes, you have Caesars, you have MGM. I just think it just costs too much, Vinny, to get in. So there's a barrier to entry there for sure. So, and Genius Sports, in talk about B2B AI play within the sector, again, I think the complexion of the stock's been hurt by a large private equity seller that owned the stock before they even went into the SPAC that is almost cleaned up at this point. It's down to under 10%. And I think they report next week. I think the quarter is going to be fine, but I think that's a huge opportunity. Stock is very cheap to me, and that's a great way to play it as well. Yeah.
Another name that we're involved in, it's a vice. Again, another vice that we don't partake in, but if I were to tell you what was one of the fastest growing consumer products in the United States, just ask you, what do you think it would be? It could be the fastest.
Are you talking about cannabis? What are you talking about?
It's close to cannabis. I'll give you that. It's Zyn.
Faster than cannabis.
Oh, Zyn, the thing. Philip Morris. You're going to Philip Morris.
Philip Morris.
Okay.
So we recently have taken a position and actually have made it a decent sized position, a regular sized position in Philip Morris. And if you're a value person, the dream for value people is that you own a value name that actually has the shot to become a growth name at some point. So rewind the clock on Philip Morris, all the 4-letter word, declining revenue growth. Lord knows they went through the rigmarole of legal issues and the like. And up until they acquired this thing called Swedish Match, they have been at best a flat to probably minus 5% revenue growth company. Along they acquired this thing, Swedish Match, which owns Zyn, the product. Now, I've never used Zyn. All I know is that they're growing units year over year to the tune of 40 to 60%, to the point where revenue growth is actually inflecting to a positive. Not crazy positive, but a positive. And this is a company that has 40% EBITDA margins and talk about moats, a fairly incredible moat in what they do. So we've been acquiring that name, and we feel like there's massive upside as they delever from the acquisition of Swedish Match.
Got it. All right, moving quickly here, and then we'll wrap this up, and I'll give you Derby picks here, is that obviously huge news in cannabis sector, that the DEA followed through on HHS recommendation. It appears to reschedule cannabis from a Schedule 1 drug to a Schedule 3. That does open this up for listings on exchanges, potentially opens up alcohol companies being able to get involved, banks to lend to these companies. The stocks had a huge move, obviously, on the news, somewhat expected, but never expected in cannabis because things never seem to go that way. You guys own a name, Glass House, GLASF, producer out in California. I believe you're still long. Stock had obviously a good day. It's had a nice run since you guys started talking about the stock here in General Porter. 30 seconds on Glass House here, and then we're going to wrap this up with some Derby picks.
First of all, I don't know how we didn't start with this, the good news, but I think Glass House is I think the U.S. listing is coming next on the big stock exchange, NYSE. Obviously the revenue growth is just about to inflect in the next 2 quarters. So you have a really great organic revenue story. Stock's really cheap, and I think it can more than double from here. So I think it went up as high as 10. I think it's pulled back to 950. So I'd be a buyer.
All right, Run for the Roses, Saturday late afternoon. I have to put on Dan's glasses and stretch them at the moment because I can't see all my notes that I've been taking from the Derby. So I apologize, Dan. Hopefully they won't stretch too much. So Vinny, Saturday afternoon, your boy Mike Rapoli from Queens, your age. He went to Holy Cross High School, your rival to Malloy. This is his 10th shot at the Derby. Unlucky last year when the favorite Forte was taken out for a bruised foot. This is the 17 horse, right? Coming out of the 17 slot. 17 slot has never won the Derby. I think it breaks tradition this year and it wins it, coming off a win of the Florida Derby, Todd Pletcher, Johnny Velasquez. So I want to let you know the 17 horse, I think, wins this race. He's currently 5-2. And I never look at odds like at stocks before I look at what the horses are. And this happens to be, I think, a strong favorite. So 17 horse. Followed by Sierra Leone, the 2 horse, who won the Bluegrass, was sold for $2.3 million. This is a class horse for sure. I think it probably gets up there. Then it gets interesting. You got a Japanese horse owed to the Bank of Japan here called Forever Young. A Japanese horse has never won the Derby. The horse is 5-0. Just won the UAE Derby in the Middle East. No horse has ever come and won the Derby from there. They're 0-19. Again, traditions are made to be broken here. Honor Marie had won twice as a 2-year-old. That's the 7 horse at Churchill. I'm a big believer that if you've won on the track, you're going to run on. And it won at 1 1/16. This is a 1 1/4 race. Let me go quickly through these. Stronghold, the 18 horse, won the Santa Anita Derby over Starlight, our friend Jack Wolf's race Imagination. I don't think it's getting enough respect. It's raced 6 times, never worse than second. That's the 18. And then a few others, the 4 horse Catching Freedom, 15 Domestic Product. And then throw in one of the Justify Colts, either Just a Touch or Just Steal, the 8 and the 6 horse. So here's how I like to play it. I would bet the 2, 7, 11, 17, 18 Exacta and Trifecta box. Just so you know, on a $2 bet, that Exacta box would be $40. And on a $2 Trifecta box would be $120. I do like I said, I bet fierceness across the board. But some of these horses that I mentioned are 20, 30 to 1 that I do think like Anna Marie has a real shot to win. And then a superfecta because it's always fun. a 10-cent box with all these horses I just mentioned, 2, 4, 7, 8, 11, 15, 17, 18 will cost you $168. Drop that down to 7 horses, kick one, it's 84. So a lot of ways to play this thing. But Vinny, I think it's Queen's time here for you, buddy.
So Rapoli, I'll give him a shout out, Mr. Franny Lou. So everyone who knows Queens Boulevard from Entourage. But the real place Queens peeps hung out was Francis Lewis Boulevard, Franny Lou. So Mr. Franny Lou, Rapoli, good luck.
Yep.
I hope he wins. Always hope he wins.
Well, guys, stick around because Dan and Guy sit down with the CEO of FactSet, Phil Snow, in a great conversation. And I welcome them back, Tubbs and Crockett. We'll be back here also at 1 o'clock Friday afternoon for a live market call once again to talk about the jobs report and Apple. Thanks, guys, for coming
Danny,
on. Yeah.
I'm gonna finish on this note. I'm 0 for 30 betting on horses, so I'm just gonna buy more gold.
Fair enough.
Had to get that in there.
All right. Or just buy more Flutter, which owns FanDuel, which you get the receipts of it. So do it that way. Be the bookie, Porter, as we say. All right, boys. Thanks.